All right, welcome back to another edition of Financial Accounting. It is Monday, March 29th. We're going to finish up talking about Chapter 8 today. It should go fairly quick. Um, Initially, 8.3, homework 8.3 was due on Sunday. There have been some issues with my accounting lab and their updates. This morning I had pushed it to today at 11:59, but I'm still noticing it's pretty slow. And after talking with the folks over at Pearson, they're confirming that they've got some slow issues going on. So I went ahead and pushed off 8.3 to tomorrow at 11:59. So 8.3, 8.4, 8.5. I'll give you time to get all those things done by Tuesday. There will be a review on March 31st for the exam that's upcoming on Friday. So 2 o'clock this Friday is exam number 4, covering chapters 7 and 8. I believe you should be able to see the practice exam and the review notes on Blackboard already. I'll set up some practice questions on my accounting lab here soon. But if you have any concerns or issues with the upcoming exam, please let me know. Let's see. Hey, there it is. Finally, it's really slow. My accounting labs are really slow. I don't know what they did, but everything's just kind of junked up. So just to point out here, the extra credit project is due on the 20th. That's coming up pretty quickly here, and we're almost out of March into April here soon. So make sure that you start practicing going through the extra credit project. Extra credit project is 11 different components, and each component you get like a practice run before you do the quiz. So it's a little bit of a weird step. So take some time and start playing around with that. You get 95% of those quizzes correct. I'll give you the full 20 points. I'll give you 100%, practically 100%. Once you reach 95%, it's 100%. You need at least 70% to get any points at all. So anywhere between 14 and 20 points is available to you. So my recommendation is, again, don't delay this too long. Go in there and start playing around with that. It's a really great way to help shore up any information that might still be a little bit tricky for you. We're going to jump back into the chapter. Let's see, we were talking about 8.3. We talked about settling, accruing for, and then paying out the payroll tax liabilities. The next one down is warranty-related liabilities. Now, before I jump into this, one thing to be aware of when it comes to warranties, a lot of companies tend to work with a third-party insurer when it comes to any type of issues with their product. So warranties are often offered to you, like a 30-day warranty, 60-day warranty, 1-year warranty, whatever. What I sort of find is for electronics, usually a lot of big companies tend to work with a third party to do any type of compensation for people who had, for whatever reason, they were not, their product was defective for some reason. So in this situation, we're going to talk about companies that just they pay out compensation directly to the customer. So this is a situation where we're going to compensate somehow our customers for any defective products. Now, this is kind of a vague topic because there's all different types of defects. I mean, there's some people who don't even know how to turn something on, right? But there's also some type of repair work that we can pay out to have something fixed, either in-house or out-of-house. So there's all different types of issues associated with warranties. All I really want you to know is how to accrue for warranties and how to account for any amounts that are paid out when a warranty claim is made. But realize that this topic is pretty complex, and it's usually something that we have to go in more detail in intermediate accounting. So for you guys, just realize that warranties are a way of just making somebody whole. They paid money for a phone, it's not working, bring it back, we'll fix it. When do we record a warranty liability or expense? Well, realize that it's something that is only recorded if historically we have any type of track record where we're paying out money or replacing a product that's defective. Generally speaking, most companies all have some sort of warranty repair work that they do for the product. So it's not really a concern about whether or not any products will be defective and therefore the customer has to be compensated. The real question is, what's the likelihood and what's the amount that we have to accrue for? So in this situation, when we sell products that have warranties, we don't wait for a customer to come in and say, hey, I've got a defective product. At that point in time, we should have already accrued an expense for what we think will actually be brought in. So we're going to make an estimate for any type of warranty expense we predict that will happen in the future, and we're going to record a warranty payable for that potential payout in the future. We need to record them in the same period as the product sale. And this sort of harkens back to the expense recognition principle. We got to match our expenses with revenues, because for every dollar that we earn in revenue, we need to know exactly how much it cost us to generate that revenue. A lot of people tend to have concerns about this. And I'm just sort of taking a preemptive strike if you're one of these people. If no one has returned any defective goods, why must we record an expense along with the sales revenue? And this is similar to what we saw in Chapter 5, where we accrued for a bad debt expense or uncollectible accounts expense. If we're offering a warranty, generally the warranty is offered as a means to induce a sale or to attract business. So you kind of have to sort of imagine how much would we have generated in revenues if we did not offer a warranty? Generally speaking, if we didn't offer any warranty, we just simply said, hey, buyer beware, right? You probably wouldn't be making a whole lot of sales. But if we offer a warranty on our products, we'll probably see an increase in our sales revenue. So the idea here is the fact that we offer a warranty means that we're probably generating more in sales than we would have had we not offered this warranty. So there is an expense associated with this increase in revenue, and that is the warranty expense. We're matching an expense related to this increase in revenue because there's a warranty we offer. The expense itself is based on an estimation, what we predict will happen. But the reality is it takes money to make money. So there's an expense associated with that warranty that we're offering. We just have to realize we might not have sold the goods if we didn't offer the warranty. So we need to match the warranty expense with the revenue. And this is similar to the allowance method when we sell on account and people owe us money in accounts receivable. We might not have sold the goods if we didn't offer to sell on account to customers, right? If someone came in and said, hey, here's, I'll pay you back on Friday, we'd say, no, sorry, dude, that's cash and carry. They probably would just walk. So we offer, hey, okay, I trust you'll pay me back later. So go ahead and set up an account receivable with you. So I'm generating more sales because I let people pay me back later. There's an expense associated with this stuff. So just realize that this whole matching thing is requiring us to do a lot of these predictions about the future. And we need to realize that there's a lot more going on behind the scenes than what we have time for in this class. Offering warranties is a way to bring in business. It's a way of marketing our product. It's a way of advertising. Hey, we have this product, and most competitors offer a 60-day warranty. We offer a 90-day warranty, right? There's a cost associated with that, though, right? That's what we're trying to capture here. If no one has returned any defective goods, why must we record a liability right now to compensate the customer? This is also a typical question I get. Recording an expense is a debit. What's the credit going to be? It's not going to be to cash. It's got to be to some other type of an account. So I'm simply telling you that by default, we need to credit something. In this case, the payable, a liability, makes sense because it suggests that we have a potential contingent liability, meaning that I might have to pay this out in the future. In fact, based on historical data, I do pay out a compensation to my employees, or not to my employees, to my customers, or I pay to have some sort of repair work done on these products. So it's a matter of probability. I'm capturing that right now. I'm probably going to have to pay out cash in the future. That's why I'm recording the liability. And again, it's not whether or not it happens. It's more of a how likely will this payout happen. So similar to allowance for uncollectible accounts, again, we expect not to collect some accounts receivable tomorrow, so we're going to reduce net realizable value today. So this is, I guess in a lot of ways, it seems pretty pessimistic, right? We're expecting bad shit to happen in the future, and that's fine because we live in the real world. But that's important because, investors and analysts and even government officials, they look at our financial statements and they trust that we know our business well enough to go ahead and say, this is the reality. We're probably not going to collect this, or hey, we're going to have to pay out some amount in cash for these warranty repairs. If we don't do that, we don't show these expenses, we're overinflating our net income. And I know we've been talking a lot about, in chapter 7, we talked about estimations for residual value, estimations for um, uh, useful life. We talked about how many people in chapter 5, we talked about how many people might not pay us back. We're talking about estimating uh, how much in repair work will come back to us under warranties. There's a lot of estimations that go on in accounting. People tend not to really appreciate that too much. That we're not just bean counters here. Sometimes we have to estimate the beans, if you will. So what I'm telling you here is that accountants rely on historical data because we need to enact professional judgment. And not only that, you have to realize that companies like Amazon, for instance, they are audited by public accounting firms. My clients included companies like AT&T and T-Mobile and a handful of small real estate clients and real estate developers. And I would have to come in, and any type of estimations they made, they'd have to give me supporting documentation that helped me derive those calculations. If I didn't believe any of their inputs, they would have to potentially make adjustments either upwards or downwards, even if the historical data or the trends were suspect. A company may not have historical data, that's fine. That doesn't excuse them from doing some sort of calculations or estimates. That's why the AICPA has industry guides that helps companies, especially new startup companies, figure out a way to make estimations that for types of accruals that they're just not used to handling on a regular basis. So just realize that we're beyond possibility in accounting. We're living in the real world. It's all about probability. We have some historical records, or the industry has some historical data that we can rely on. But the difference between possibility and probability is basically saying, hey, it's possible we can have rain tomorrow here in Lubbock, but it's just not probable. So we're talking about probability and statistical analysis. And that's, we'll get it more into contingent liabilities in 8.5, but that is a fact that we have to address even when it comes to accounting for things that we don't necessarily have any type of data for. Here's the example. Assume we sell 10,000 units. Sales revenue 150, cost of goods sold 100,000. Here's the journal entry to record the sale. Now, like I said in the last class, there are accruals that we need to record for certain expenses or liabilities that are basically triggered by another transaction. So this is just another thing that, again, businesses tend to get in trouble if they don't think about this. We need to be aware that we've incurred an expense just from selling some goods. We've already recorded cost of goods sold, but are there any other types of associated expenses? If there's a warranty associated with these sales, and we say historically 3% of units sold require some type of repair. So we'll just talk about repair at a cost of $10 per unit. Okay. And maybe we outsource this to some sort of local shop, or we do it in-house. Either way, we need to make an estimation. So we're going to say 3% of the times the number of units sold means potentially 300 units will come back. Again, historical data indicates 3%. Fine. So we're going to say 300 units times about $10 per unit gets us a $3,000 estimated future cash outflow. We're not paying any cash right now. We're just going to record an expense because we need to match that expense with the revenue. So in other words, we earned $150,000 worth of revenue. In addition to the $100,000 cost of goods sold, there's also going to be a $3,000 warranty expense for potentially repair on those specific units we sold. Again, we want to match all the expenses associated with that particular sale. That includes making an estimate for any future warranty repairs on those units. So we're just going to say, in the perfect world, we have this information. We'll accrue the warranty payable and record a warranty expense. Fine. That's just based on a guess. We're just making an accrual based on the guess or historical data. Assume 280 of the 300 units are replaced, or we'll just go ahead and say fixed. I don't like that word replace. Usually we just fix it somehow. That's the cheapest way to do it. We'll just go ahead and fix these units at $10 per unit. We pay the cash out, $2,800 total compensation costs, if you will. Basically, this is work that we're doing on the product to make it work again. So we're compensating the customer to make them happy. If they're not happy with the products, we're fixing those things. Here's how I compensate them with a better refurbished unit. Compensate the customer. We just need to reduce the warranty liability. We don't need to record any new expense. No new expense. We've already recorded that. It's like ripping the Band-Aid off. So in this case, I'm not debiting any expense. I'm just reducing the liability because I'm in fact compensating my customer with a fixed repaired unit. So I'm paying cash. Let's assume it's $2,800 exactly, right? In this case, that reduces the liability down to 200. So the 200 represents potentially $200 more worth of warranty service work that we need to do on these units. Typically what people ask me is, what if the actual amount of repair was something like, say, $3,500 instead? Well, if we did have $3,500 worth of warranty work, I would record the $3,500, pay out the cash of $3,500, and this would create a weird looking $500 debit balance. That's weird. Liability should be a credit balance. What this means is I spent more on repairing these units than I had estimated. If that's the case, and let's say that was for all 300 units, if that's the case, I would make an adjusting journal entry later, where I would just credit the account to make it go to zero, and then I would just debit another $500 to the warranty expense. In other words, making an adjusting entry later on is going to be necessary. We're never going to hit the nail right on the head when we make these estimates, right? That's why we make adjustments later on. So if we had to make that adjustment, we'd have $3,500 total warranty expense, which is more than the $3,000. If this $200 is never actually realized, in other words, let's assume that our customers never come back. So this $200 is just lying around in the estimated warranty payable account. What do I do if that warranty expires? Well, I just get rid of it and do a debit there and do a credit there. And that brings that whole thing down to $2,800. And this brings it down to zero. So again, these accruals that we're making, they're just guesses. If we need to bump it up or bump it down, we can do so later. But we're not doing a major recognition for like the $3,500 in expense at one time. We're doing it only in small adjustments. And the FASB says that's preferable than just sitting around and waiting for customers to come back and just say, hey, fix my shit. So bottom line here is we're making accruals. We're recording it to the payable account, the warranty payable account. As we pay cash out, we're not debiting the expense. We're just debiting the payable that we have set up. So the payable is just like a worst case scenario contingent liability, which we'll talk about more. There's really only one deferred liability that we have to worry about in this class, and that's the unearned revenue account. And we call it a deferred liability because what we're deferring is revenue. We're pushing off revenue recognition into the future because right now we've received some sort of cash in advance and we haven't quite earned it yet. So what do we do with this? Well, we essentially say it's not ours. So until we actually perform the service or deliver the goods, we need to basically set this aside and say it's not really our cash. In this situation, we incur a liability to either deliver the goods or perform services. But don't forget that if we fail to deliver, we get to refund the money too. So this liability either represents delivery of goods, delivery of services, performance of services, or a refund, potential refund. So that's why they tend to be called prepayments. Banks call them deposits because legitimately it's your cash at the bank's holding. So the bank has the cash and they show a liability for these deposits, right? Here we're talking about prepayments for potential revenue. That's why we call it unearned revenue. It will be realized as revenue later, but if I'm a property manager and I get cash right now from my tenants, it's considered unearned rent revenue until the time goes by. The renter, the tenant, records prepaid rent. The landlord records unearned revenue. So down below, the example is, assume that we get prepayment for 1 year and we collect $60,000 on July 1st. Okay. As soon as you start seeing dates, please draw out a timeline. Please do this. I don't want you guys missing points for miscalculating the number of months here. We're starting here on July 1st. Now, unless the problem says so, you have to assume that the fiscal year end is December 31st. So right off the bat, I was going to like sort of draw a line here. Assume if there's no information to the contrary, I'm just going to assume that we'll have to make an adjusting entry on December 31st. It's going to cover 1 year. Now, a couple things you can do with that 60,000. One, you want to pay close attention to how long. This is the number one way people miss points in the exam, is they don't pay close attention to how long the contract applies. In this case, it's $60,000 of prepaid rent. We're going to earn this evenly each month that goes by. So you can take the 60,000 and divide it by 12, and you get, I think that's $5,000 per month. So every month that goes by, we've earned $5,000 of this. So assume that no journal entry has happened since then. We're going to have to do a pretty big adjustment at the end of the year. Right now, I just want to put it into the unearned revenue account. In this case, it's a current liability because the contract's only going to last for 1 year. So I'm going to debit cash for 60,000, credit the liability for 60,000. That's at July 1st. Now, most companies will have a month-end close where they usually update this $5,000 every month. Assume that we haven't done anything until we get to December 31st. What is the adjusting journal entry we record at the end of the year? Well, 1, 2, 3, 4, 5, 6. 6 over 12 is 1/2. We'll just recognize 1/2. So we're going to shift $30,000 from the unearned liability account, unearned revenue liability account, to the income statement as rent revenue. We've earned that because time has passed by. Simple as that. Assuming our customers are happy to, they're going to stick with us, so they have another $30,000 worth of access to their rented space. We owe that access, or we owe that money back to them. But so far, we've earned $30,000. So those are all the notes for 8.4. Are there any questions about 8.4? All right, 8.5, contingent liabilities. Warranties are like a contingent liability. It's a potential liability, a potential payout in the future. Now, there are some that arise because we did some sort of business. Fine, we have a product warranty that triggers a journal entry, typically for us. Other contingent liabilities tend to be things for like lawsuits. Most of the time they're lawsuits, but they can also be for any type of, maybe we have like a bad weather system that's looking to come our way, or maybe we have a business in Florida and we have to worry about potentially incurring some losses due to a hurricane coming through, right? Generally, they're lawsuits, but situations arise where there's some type of an event. This isn't really transaction driven. It's really just more about events that happen to us where we simply say, I got to record something. So depends on any type of future outcome. But right now, the question is, can we predict any type of future outcome? And again, a lot of estimations come into play here. Now, I will tell you this, that generally accountants, as much as data can help us make these estimates, in the case of contingent liabilities, we tend to rely on lawyers a lot. So when I was an auditor at PwC, I would go to a client site and I would say, okay, are you currently undergoing any type of lawsuits right now? Are there any pending lawsuits outstanding right now? And they give me a list of lawsuits, 1, 2, 3, 4, whatever. And usually next to that, they give me information about the percentage likelihood of them potential of being held guilty or having to settle out some amount. And so the percentage likelihood, can range from anywhere like 100% down to zero. So maybe they have one that's like 75%, one that's 25%, and a handful that's 5, maybe this one's 1%, right? Typically what I do is I contact, if they use outside legal counsel especially, I will contact their outside legal counsel with what's called a confirmation. So the confirmation letter will include this detail. And I'll ask the lawyers, I'll say, as of the December 31st period end date, are these percentages accurate as of December 31st? And I'll also say, because usually auditing happens within like the first 2.5 months. Let's just say this is March 15. Auditing a public company tends to happen in the first 2-3 months of the next fiscal year. So if I'm auditing the company at this point, I'm sending out a confirmation to the lawyer saying, are these numbers correct as of December 31st? And is there any new information to date that suggests that these need to be updated? And if the lawyers say, nope, these are correct probabilities and there's no adjustment since December 31st balance sheet date, then I usually look at that as good outside confirmation as to whether or not accruals need to happen. But there's 3 rules, and you just need to know these for the sake of the exam, because I'm always asking people to answer some questions related to probabilities and estimation. So the most concerning contingent liability is this one, where we have to both record a journal entry, accrue a liability, record the journal entry, and disclose information about that liability in the notes to the financial statements. And the notes of the financial statements happen after the financial statements are presented. So in that 10K, recall that there's several pages in the 10K. See if I can draw today, right? So you got these financial statements, right? Then after these financial statements, balance sheet, income statement, statement of cash flows, etc., then you have what are called notes. Sometimes they're called footnotes that occur after the financial statements. And all these footnotes are basically saying is, here's the context behind the numbers you see on the financial statement. So there's information about accounts receivable, about property, plant, equipment, and there's information about liabilities, especially contingent liabilities. So if the company's involved in a lawsuit, and there's a high probability that they will lose the lawsuit or have to pay out some amount of money, that check marks one of 2 necessary criteria. If it's probable that the company, that we as the company, will lose the lawsuit or pay out some money, and we can estimate the amount of the loss, we have to accrue and disclose, meaning that we have to show something on the balance sheet and the income statement, and we have to disclose the nature of the lawsuit in our footnotes. It is the worst case scenario where we really fucked up, and so now we are recording and disclosing this information. So the journal entry would be something like a loss from a lawsuit. I think your homework calls it lawsuit loss or lawsuit expense or something like that. But essentially, it's a loss, meaning that we have lost value not by our own direction. We have lost value because somebody said that they spilled hot coffee in themselves, right? So we're going to record something on the income statements. It's going to stick out like a sore thumb. And then we're going to accrue a liability, because assuming that we haven't settled out the claim yet, we are going to wait and see how this whole thing plays out in court. So we just accrue a liability on the balance sheet. Worst case scenario, that's what we have to do. But there are situations where potentially we cannot estimate a probability of loss. There's also situations where maybe we can estimate the probability, we know we're going to lose, but we don't know the amount it's going to cost us. If either of these If any one of those is violated, it kicks us down into the next level, number 2. And this is where we don't accrue any amounts. We just disclose the nature of the lawsuit. And we'll go through an example, look at Amazon here in a bit. But that's a situation where it's reasonably possible. And that's a key word, possible. When you got probable and estimated, boom, you've got yourself the worst case scenario. But if you have only reasonable possibility, you're just going to disclose it, meaning that, hey, we couldn't do 1 or 2 of the above. Fine. That's number 2. We just put it into our footnotes only. Best case scenario, and this happens a lot, like companies are sued more than you think. They don't report anything. And those are situations when it's remote. If it's unlikely, truly unlikely, that we will lose this lawsuit, it's what's called a frivolous lawsuit. That's a legal term. We're neither going to accrue anything nor disclose it. So the balance, now this seems like a lot of people tend to say, isn't that kind of like hiding lawsuits? Shouldn't we disclose or just report something because we're being sued? And the answer is no. And the reason why we don't disclose anything, even disclose anything in the notes, is because there's a risk that we might scare off some potential investors, or we may have some existing investors that divest because they see a lawsuit and they freak out. So the problem with being an accountant is we have to be neutral. And that means don't be conservative and record and report everything. And don't be aggressive and avoid disclosing at all costs. You have to be objective. You have to be right in the middle. And that's why the FASB has these rules. And it says, look, generally speaking, there are pros and cons of going either direction. So the best thing to do is just follow these rules. So 1, 2, and 3. Number 1, probable and estimated, you got to accrue and disclose. Reasonably possible only, just go ahead and disclose it. If neither of those things are the situation, we get a remote possibility, let's just go ahead and just avoid doing any of this stuff. We already kind of like went through and pulled up the financial statements for Amazon in the previous class. So you know how to do that if you want to play around with it. I looked this up. This was from 2016, Amazon's 2016 financial statements. They have a footnote disclosure. They just call it Note 7 to their financial statements. It talks about commitments and contingencies, in this case, legal proceedings. So this is a clear example. In the situation, Amazon Corporation is being sued, as well as its subsidiary Amazon Payments Inc. So companies can own other companies. Typically what companies have are called subsidiaries or wholly owned subsidiaries, just for legal reasons. You know, this is a law class. And just trust me on this. Walmart had like 280 different subsidiaries. It was ridiculous. Amazon has a subsidiary that handles all the payment processing. Amazon Payments uses technology, proprietary software to handle all this. Now, there is a company called Big Baboon Inc. that creates such payment processing software. And they found out that Amazon is using very similar technology. And so they're claiming that there's a patent violation. So third party selling payment technology infringes patents owned by Big Baboon. And here's the key thing. Let's just say that they are right, that there was a patent. What are they really seeking? What do they really want? They're seeking an injunctive relief, which basically means Amazon needs to stop doing something. There's no money that's really being asked for here, at least not as that date. So the outcomes of our legal proceedings are inherently unpredictable, of course, subject to significant uncertainties. That's why we're talking about contingent liabilities. An estimate of the amount of loss or a range of the loss is not possible. And the reason why is because they're asking for Amazon to stop doing something. They're not saying pay me money for violating the patent. Just stop using your technology because it's violating my patents. So they're saying that we cannot estimate a loss. So remember, from situation number 1, it needs to be probable and reasonably estimable. And that will require us to do some sort of debit credit and disclose. But here they're saying, hey, this situation up above is not estimable. So where does that put us? Well, it's some matters in this situation, because they're disclosing it, they're saying that it's reasonably possible, meaning that they just disclose it. And that's why you see it up in their footnotes. They're acknowledging that they may have to result in the loss that may result potentially from the outcome from this lawsuit, but they don't know how much. And that's the reason why they can't accrue anything. They can't record a debit or credit because there's no money that's being sought here. This is certainly not, if it was situation number 3, where we're talking about remote, there would be nothing, not applicable. If it's remote, you wouldn't even see this note disclosed in the financial statements. So the fact that Amazon is actually disclosing anything means that it's somewhere 1 and 2. But they're saying it's actually not 1, it's only 2 because no amount can be estimated. That's the example of the application of the rules for contingent liabilities. When in doubt, don't just disclose it. Go through the rules and figure out, have I met any of these? And on the exam, I'm very careful about the verbiage that appears on there. So just make sure that you're comfortable with those. Please don't miss points of that. Take your time and read it carefully. And when you're reading through the problem, if you think that something just appears worded weirdly, use your best judgment. But I'm happy to talk to you after your exam if you're concerned about how a problem confused you. Those are all the notes I have for 8.5. If you're good to go, feel free to log off. If you have any questions,